Can you time the markets? Yes, I think you absolutely can as long as you're using the right strategies. Markets have cycles, and you can make more informed decisions if you know where you are in the cycle. Even the greatest investor alive today suggests that your sentiment towards investing should alternate between being fearful and greedy depending on what the market is doing, which of course changes over time. But you want to be careful because there's a right way and a wrong way to do it. And if you search online and read the comments on message boards, you'll probably find a lot of critics who say timing the market doesn't work, especially long term. So in today's video, I'll break down the market timing strategies that actually work and talk about some of the factors that go into it. Let's start with setting some reasonable expectations first. When I say it's possible to time the market, I'm not claiming that you can actually predict when the market will plateau and crash and when it will bottom out every single time. That's virtually impossible to do long term because nobody can predict the future with that level of precision. But what I am saying is that the market can be irrational. We know this because sometimes the market is cheap and sometimes it's expensive relative to historical measurements. Although the overall cycle can be predictable, the duration of each phase can vary widely from one business cycle to another. Buying assets when they are cheap gives you better returns long term. This is why if you're accumulating assets, you want a market correction to happen rather than just a gradual bull market. A pullback gives you an opportunity to buy more investments with the same amount of money. This assumes your investments will eventually bounce back, of course, which I'm sure they will if you've done your research. So, what should you be looking for when trying to time the market? Well, the most important thing is to monitor the economy. At the end of 2019, I just sold my farmland and I was sitting on $100,000 in cash. Normally, I would have invested all of this into the market because I like to be fully invested. But what held me back from investing this time were economic factors. The 2 year government bond yield was higher than the 10-year for the first time in a long time. And when this happened before, you would typically see a recession 6 to 18 months after. This indicator is so reliable that it happened basically 100% of the time over the last 50 years. Another indicator was the unemployment rate, and it was bottoming out. It was at a 50-year low, and a very low unemployment rate is generally followed by a sharp spike up and a recession. The uncertainty index, which measures policy related worries around the world, reached an all time high in 2009. And even the Federal Reserve Bank of New York was predicting a recession soon. I wrote a blog post in 2019 detailing these different indicators, plus six other recession signals that had all the warning bells going off. So it wasn't just one indicator predicting this, it was almost a dozen different signs all pointing towards the same outcome. So this all made me hesitate, and I just wanted to keep some money on the sidelines and wait to see what happens. Then, of course, we all know what happened in early 2020. The market had a huge 30% sell off. And that brings us to the second factor to be aware of, which is market valuations and, by extension, individual stock valuations. Practically speaking, there are a lot of different metrics you can look at here. Return on invested capital and free cash flow are often solid measurements to consider. But for now, let's look at the frequently used price to earnings ratio, which is a measurement to determine how expensive a stock is. It divides the stock's current market price by its annual profit. Generally speaking, a ratio of 5 times is considered cheap. This means it will take you 5 years for your investment to double. That's a pretty good rate of return. 15 to 20 times ratio is average, and a ratio of 30% means the stock is probably overpriced. Again, this is just a generalization, and there are lots of exceptions. So, by the third week of March 2020, an energy company named Canadian Natural Resources was trading at less than 3 times its earnings. So, this really low PE ratio had to drop because its share price fell more than two-thirds from the top. It was clearly an undervalued company. So, this is when I jumped in and bought 500 shares of C&Q. This was a larger purchase than I would normally make, but I knew negative oil prices weren't sustainable. And C&Q is a cyclical stock that goes up and down in somewhat predictable cycles. You don't have to know how long each cycle will last. All you have to determine is where in the cycle you are now. And it was pretty clear to me that C&Q was near the bottom of its cycle. But instead of the highly volatile and cyclical nature of energy stocks, let's say you wanted to invest in something a bit more stable. Well, I'm a big fan of dividend growth stocks, so a simple and useful metric to track is the dividend yield. For example, TD is one of the largest banks in the country, and its future profitability is fairly predictable. It has a really large moat and a long history of growing its dividends for decades. So when TD's dividend yield reached 6% last year, I almost couldn't believe how far the share price dropped. and I immediately bought 500 shares. TD and any other Canadian banks really rarely yield 6%. So when it does, it's a very strong signal that the stock is cheap, and it probably won't stay that cheap for long. I normally wouldn't put so much exposure into a single company because too much concentration can become a risk. But I decided to make an exception because these were exceptional times. By the summer of 2020, I had invested all of the extra cash that I was holding and I was fully invested once again. Great opportunities don't come very often, so when they do appear, make sure to double down on them. And these strategies of watching economic indicators and asset valuations aren't specific to stock markets either. These skills are not only learnable, but they're also transferable to be used on other asset classes. For example, for real estate investing, the sales to active listing ratio is a fairly accurate measurement to assess the market sentiment. 20% or higher means it's a seller's market. Usually, this is a great predictor of higher prices in the future. 12 to 20% means it's a balanced market. And anything below 12% is considered a buyer's market, and this indicates that prices will probably fall in the near future. This is a fairly reliable statistic that can tell you how the market is doing. In Vancouver, for example, the local real estate board puts out this information every single month. So most of the time, it has been a seller's market here. But just like any market, there are cycles. And in the summer of 2020, there weren't that many buyers competing with each other. So the ratio was lower, and it was actually a pretty balanced market, which was pretty rare to see in the city. Another indicator I like is really simple, but also very effective, and it's basically just the price movement itself. So here's a chart put out by a local real estate agent. It shows the year over year changes to condo prices. Notice how Vancouver does experience corrections occasionally, but prices always recover quickly. This means it is possible to time the market and buy a property when prices are suppressed. I usually like to wait until the chart has bottomed and then make a purchase during the early stages of the recovery when prices are still cheaper compared to a year ago, but it's on its way up. So far, I have invested in two condos. I bought one in 2009 and another in 2019, and both properties have been doing pretty well. And you can probably see as a corollary, there were definitely times when it would not have been a good idea to buy. It's simply a matter of looking at the market cycle and using data to make informed investment decisions. So you can also combine these strategies with technical indicators to help you time the markets. I mentioned in the previous video in June that Bitcoin has probably bottomed out based on technical analysis, and I was starting to accumulate more of it. And since that video came out, Bitcoin's price is up about 50%. So you can learn to track these indicators for currencies, commodities, or any other asset. Keep in mind that behind every currency, there are people producing real economic activity. Behind every stock or bond, there's a real business that's making a product or service. Timing the market properly simply means you understand the quality investments that you want to buy and then simply load up on them when they go on sale. This means when the market falls, you intentionally try to time it and buy more at discounted prices. If you've watched this far into the video, thank you so much, and I want to share with you a personal mental model that I haven't told anyone else before. Warren Buffett's idea of alternating between greed and fear implies that you can time not only when to buy, but also when to sell in the market. But I've always had a little bit of a problem with this because as a long term investor, I don't like to sell my investments unless there's a really good reason. As Charlie Munger would say, the first rule of compounding is to never interrupt it unnecessarily. If you want to sell some good investments to rebalance, that's fine, but generally, I don't think being overvalued is a good enough reason on its own to sell an investment. So here's my alternative to Buffett's original saying: buy when others are fearful and hold when others become greedy. This works wonders with dividend growth stocks, by the way. Like with my TD example, even if the stock price continued to fall after I bought it, I can patiently just wait for the company to recover while earning 6% in annual dividends in the meantime. So the best time to buy is when there is blood in the streets, even if some of that blood is your own. Of course, there's no guarantees with investing, so all of these strategies and indicators and ratios that I've shared today are just probabilistic in nature. So the more data you have, the more certain you can be of your decision. But there is no such thing as the perfect signal. And because investing is based on probability, luck plays an important role. Even if you found the right time to buy something, you still have to ask yourself if it's the right investment for you. You have to plan an exit strategy as well, because what if you made a mistake in your decision making and maybe you bought a stock that eventually goes out of business? Do you have a stop loss plan to limit your downside risk? These are all important questions that you have to ask yourself before putting your money in harm's way. That's why I made this video, which breaks down 7 practical questions to help you make better investment decisions. Feel free to check it out if you haven't seen it yet. So, timing the market is certainly possible. Now, should you time the market? Well, that's a whole different topic. Anyway, thanks for watching. Happy investing, and I'll talk to you next time.